Thank you for tuning into the webinar today on impact of VAT on exports and imports in the UAE. I'm Rajashri from the Zoho Books team. Most of you here will be knowing Zoho Books, but for the benefit of those who are new and trial users, Zoho Books is our VAT compliant accounting software which helps businesses manage their finances. We have with us Mayank Soni, who will be the presenter for today. He is the managing director of Max Growth Limited and Max Growth Consulting. He is also a corporate finance and consulting professional with over 19 years of expertise on VAT advisory, international taxation advisory, and private equity. He has worked with large MNCs and government organizations such as the Office of His Highness the Crown Prince of Dubai. And you can find his articles and columns on VAT in Khalij Times and Gulf News. He is a well-recognized VAT expert and a member of the Indirect Tax Committee of ICAI in the UAE, responsible for evaluation and training for ICAI's certification courses on GCC and UAE VAT. Today, we have him sharing with you his insights on the various aspects of VAT and its impact on your business. On behalf of all of you, I welcome you, Mayank. So, without further delay, let me hand over the webinar to him. Over to you, Mayank.
Thank you, Rajshri, for the introduction, and good afternoon, everyone. And as we are into the peak summer season in UAE, the VAT is taking its own toll on a lot of businesses. I, as a practicing VAT consultant from Max Growth Consulting, I'm here to resolve as many issues as you have, especially for today's topic, which is how does the VAT impact the imports and exports. So I believe everybody who is tuned into this webinar or who will be listening to this audio has a business of import or export, whether in goods or in services in some way, or is looking to enter into that business. And the impact of that is quite complicated as far as the export and import business is concerned. And we will try to cover all the aspects in relation to that in our today's webinar. So we'll start with exports under VAT. And before we come to the VAT impact, it is important we all understand the definitions based on which the impact of VAT on exports is determined. Because these are the definitions which define the governing principles on what and where the VAT is applicable. It's more complicated in case of services as compared to goods. The first definition which we all need to understand is the definition of export. The VAT law of UAE defines the exports as goods departing the state or the provision of services to a person whose place of establishment or fixed establishment is outside the state. It's important to understand here a very subtle difference which is there between definition of export of goods and definition of export of services. As far as the goods are concerned, the condition which determines whether the goods are exported or not is whether the goods physically were departed from UAE or they physically left UAE after clearing from customs from UAE. That is when the goods become export. Whereas as far as services are concerned, there is an additional requirement for a service to be considered exported. The recipient of that service has to be a person or a company who has a place of establishment or fixed establishment outside of UAE. And we will cover in more detail what is meant by fixed establishment and place of establishment. Now, coming down to the differentiation of what is the goods and what is services, we come to the goods first. Goods is defined as any physical property that can be supplied, including real estate, water, and all forms of energy. So the goods have been clearly defined in the VAT law, and any tangible item is considered a supply of goods. Whereas services have been kept as a very broad-based definition, and it's defined as anything that can be supplied other than goods. So if you try to say that you're not supplying goods, by default, you will be considered as supplying services as long as there is a supply. A supply means any kind of benefit which is transferred to another party is considered as a supply. Either it will be a supply of goods if it is of some tangible item. If it is not considered as goods, it is supply of services. Important part to understand is the real estate, water, and energy. These are considered as goods, which generally in the normal parlance might be dubious, but as far as the VAT law of UAE is concerned, they have been clearly defined that they are goods. Now, real estate cannot be practically exported out of a country. So the place of supply of real estate will always be UAE, and nothing in real estate technically can be exported because real estate is based on the place of supply, which will be UAE. So as far as exports of goods are concerned, the real estate can be taken out of that definition altogether. Now, coming down to the place of establishment or fixed establishment, which determines whether or not you are making actually an export, because these are the criteria which you have to fulfill. Now, the place of establishment is defined as a place where a business is legally established in a country pursuant to its laws of establishment, or in which significant management decisions are taken and central management functions are conducted. Whereas a fixed establishment is any fixed place of business other than place of establishment in which the business is regularly conducted or where sufficient human and technology resources are present. Now, what becomes important is that the definition of place of establishment or fixed establishment is not only limited to you having a registered office in UAE. Even if you have a registered office in a country outside UAE, for example, a lot of companies operating in UAE will have their registered office or in British Virgin Island or Cayman Islands. But if the other conditions which are mentioned in place of establishment or fixed establishment, such as significant management decisions, central management function, having permanently place of business, or having the sufficient human and technology resources being present in UAE, that business for the VAT law purpose might be considered as being operating from UAE. So if you are especially supplying services to such businesses, which is a BVI company or a Cayman Island company, but for all practical businesses, their place of establishment or fixed establishment is in UAE, even though you're invoicing to a BVI entity or a Cayman Island entity or any other tax haven for that matter, they may not be considered as export of services in your VAT assessment by the Federal Tax Authority. A lot of companies have not evaluated this aspect while they are invoicing their customers for certain services, and they are just blindly considering it as export of service and making it zero rated. So I would strongly urge and request you in all your respective businesses, please evaluate the aspect and go through the definition of place of establishment, fixed establishment, and make sure the customer to whom you're invoicing does not have a place of establishment or a fixed establishment in UAE. We spoke about in the first definition export that goods departing from state or the services where the place of establishment of the customer is outside the state. The definition of state in the VAT law is the whole of United Arab Emirates. So United Arab Emirates as a country is defined as a state. Now, just summarizing what we spoke in the previous slides. So as far as the goods are concerned, if the goods physically leave UAE, they're considered as export and hence will be zero rated. Whereas in case of services, there are multiple conditions to be fulfilled. One, the place of supply of services technically will be UAE, and then they are exported out of UAE, which means the benefit of those services is received by a recipient outside of UAE who does not have a fixed establishment or a place of establishment in UAE. Now, the definitions or the relevant articles in the law, which we'll cover in summary. Let's talk about the goods first, or and the services after that. Important part for both of them is, as per Article 45 of the VAT Decree Law of UAE, export of goods and services will be considered as zero rated, which means they are still fall within the definition of taxable suppliers. However, if you are actually exporting goods or services, they will be subject to VAT at the rate of 0%. That has been done to encourage the export industry from UAE. They have not made the exports exempt from VAT. They have intentionally kept it as zero rated because by being zero rated, you are entitled to recover all the input VAT you pay on the expenses you incur in the course of making these exports of goods and services. For example, your entire business model in UAE is of export of goods or services, but you are taking goods or services from local suppliers in UAE who will be charging you a 5% VAT on the supplies you make. In this case, although your output is subject to 0% VAT, which means you don't have to pay any output tax to the Federal Tax Authority, but all the input VAT which is charged to you is entirely and fully recoverable. Now, as far as the recovery is concerned, you're claiming a refund if you're into 100% export business, or you're claiming input credit otherwise on your certain proportion of your business which is into exports, you will need to maintain a very strong and proper books of accounts and records of the goods or services you have exported. We are all filing our VAT returns, we're declaring our exports, and a lot of people are declaring exports without having proper documentary evidence to support that. As and when the assessment of your VAT return happens and the tax authorities ask you for the backup documents, you don't have that, you will be disallowed the benefit of zero rating of those exports. And in addition to you being subject to 5% VAT by the Federal Tax Authority in those cases, you will be also subject to penalties for wrong filing of the VAT returns. So it is very important, if you are making export of goods or services, please have every single documentary support supporting it, such as your agreements, your contracts, your invoices. And in case of export of goods, you need to have both the official evidence and the commercial evidence supporting that the goods were actually exported. The official evidence is defined in the executive regulations of the VAT law as export documents issued by the local Emirates customs department. So there are 7 different Emirates in UAE, and each Emirate has got its own custom department. So whichever Emirate you are actually exporting or physically sending the goods from, that Emirate will issue you an official document which is called an exit, a bill of entry, and other documents which will be given, including the inspection report. When they physically inspect the goods, they issue an inspection report. So these are the official evidences which are issued by the custom authorities of each local emirate. Even if your entity is registered in Sharjah, for example, but if you're exporting the goods from the Emirate of Dubai, your port is Jabal Ali port from where the goods are being departed. In that case, the Dubai Customs Authority will issue you official evidence, which includes your physical inspection report, which includes your bill of entry, which includes your exit clearance forms. All these documents form part of your official documents for exports. Whereas the commercial evidence which you will have is typically issued by your shipping company or the airline through which you are exporting your goods. And they can be in form of an airway bill, a bill of lading, a consignment note, or a certificate of shipment. So a major part of confusion in the market is they think if they have the airway bill or the bill of lading, that is sufficient proof for it being considered as export of goods. The answer is no. You need to have both the official and commercial evidence. Another practical issue which comes across while the goods are being exported is when you're exporting through courier companies or cargo companies. In certain cases, the cargo companies or courier companies don't historically provide you with your official evidence of export. It does not mean that they don't have that. You need to ask them. Historically, they don't have the practice of providing that. Even if you're sending or dispatching your goods through courier or cargo companies, you have to ask them to provide you the official evidence of export, which is issued by the custom authorities of the emirate from which you've exported. Please don't just rely on your courier company just saying that we don't provide. You have to insist and ask them, because tomorrow when you have an assessment of your VAT returns, if you're not able to provide the Federal Tax Authority with those documents, you will be disallowed the benefit of zero rating which you have claimed in your VAT returns, and also will be exposed to fines and penalties. Now, coming down to the next part of the topic which we want to cover today, and we'll be taking the questions on both the exports and the imports together at the end of our webinar. The second part of this topic we are covering is imports. Now, most of the businesses, whether they are exporting or they are supplying within locally, are importing the goods or services into UAE. The reason for that is UAE is not traditionally a manufacturing hub. It's primarily a trading hub. As per the data, based on our market research, approximately 85% of the goods which are supplied in UAE are imported from countries outside UAE. In addition, we also have exports which are made, which are also imported from outside UAE. So import is a very, very big business segment for each and every UAE business, and there will be very few businesses which don't have any imports. So by and large, every business makes imports from outside the country. Now, who is an importer? An importer, as far as the VAT law is concerned, is the person who is the importer on record as per the customs authorities when the goods are imported into the country. It is not any other party. There are a lot of transactions where there are multiple parties involved in a transaction. One party is importing. They may be selling it on a high sea sales basis to another party within UAE, or they may be selling to them after importing into the UAE. So if the company which has imported the goods, they sell it on a high sea sales basis to another company. Let's take an example. There are three companies. The exporter from another country or supplier, say from India, is supplier A, who has been placed an order by a company B, which is a UAE based company. Now, supplier A supplies the goods from India to this company B in UAE, and the shipment is in transit from India to UAE. While the shipment is in transit, the company B sells the goods to company C by switching the bill of lading, by switching the insurance policy. It legally transfers the ownership of the goods on a high sea sales basis to company C, which is another UAE company. Now, in this case, the company C, when the goods reach UAE, the responsibility to get the goods cleared from the customs authorities in UAE does not lie on company B, but rather it becomes the responsibility of company C. So for the purposes of VAT law, in this example, the company C, which has actually cleared the goods from customs using its import code and TRN, becomes the importer on record. Now, if in the same example, if the company B, instead of supplying the goods to company C on high seas sales basis, had initially cleared the goods from the customs authorities in UAE under its own import code and its own TRN, in that case, company B will be the importer on record, even though from the customs port itself, the company B directly sends the goods to the warehouse of company C. In this case, the importer on record still will be company B and not company C. So the company B will be the importer on record when they supply to company C, although it goes directly from the port After clearance of goods to the warehouse of company C, company B still will be required to charge 5% VAT to company C because that is considered as a local supply within UAE. Now, whosoever is the importer on record, as I have explained to you, will have the responsibility to account for the VAT on import of such goods under a mechanism which is called reverse charge mechanism, for which the detailed provisions are provided under the Article 48 of the VAT decree law. Now, we will talk more in detail about how the reverse charge mechanism works and what is the purpose of reverse charge mechanism and how the accounting entries of the reverse charge mechanism have to be recorded. Important part to clarify, although I gave the example for import of goods, but the reverse charge mechanism is applicable on import of goods as well as import of services. So in case of import of services, there is no concept of importer on record. Technically, any company on whose name the invoice is raised by an overseas company for services and who's importing the services into UAE. For example, if you're a consulting firm based in India and you are providing services to a UAE company, you will be raising the invoice on the UAE company for those consulting services. And as long as you provided those services from India for some business which can be pertaining to India or anywhere outside UAE for that company, for the company in UAE, it will become an import of services. So having understood these basic concept of import of goods and services and importer on record concept, we'll now boil down to the most technical part, I believe, in the entire VAT law, which is the reverse charge mechanism. It is a very simple concept, but due to a lack of understanding in the market, a lot of people have not understood it correctly, and there's a lot of alternative views going in the market. My purpose for this webinar is to clarify to you what is the right way of recording reverse charge mechanism transactions and whether or not there's an actual cash flow payment involved on import of goods or services by the importer. Now, as far as the reverse charge mechanism is concerned, a mechanism under which the recipient of goods or services is required to pay VAT instead of the supplier if the supplier is not registered in the member state where the supply is made, which means the supplier who is making the supply is not a company registered for VAT in UAE or is not a company which has got a fixed establishment or a place of establishment in UAE. In that case, the importer of those goods or services will be required to account for VAT rather than the supplier. The general rule of the VAT law is the responsibility to account for VAT is always that of the supplier. Whereas in case of imports of goods or services, the law has shifted that responsibility to the importer or the recipient of those goods or services. The reason for this is that the UAE Federal Tax Authority cannot have a jurisdiction or a control over an overseas supplier. So in case they had left this responsibility for the VAT on the overseas supplier, and in case the overseas supplier, without being registered for VAT in UAE, does not comply with those requirements, there is nothing legally the Federal Tax Authority of UAE would have been able to take an action against that overseas supplier because that is beyond their jurisdiction. That is the reason the whole reverse charge mechanism concept has been devised, which shifts the responsibility to account for VAT to the importer who is a registered company for VAT in UAE. Now, the definition, if you are looking at your slides, which I have right now open, it says the words required to pay VAT. That is how the law defines the word. And that has caused a lot of confusion in the market that you are required to actually pay the VAT in case of imports of goods or services. The answer is no, because People just have taken the literal meaning of the word pay. The word pay or payment as the way which has been defined in the VAT law includes actual payment or accounting for VAT. So when we are talking about the reverse charge mechanism, the way word pay has to be understood as accounting for VAT. Now, when let's take an example to make the concept more clear. For example, you are importing goods into UAE from UK. In case the goods which are being imported are not exempt goods in UAE, they are part of standard rated supplies, which would have been taxable in UAE at the rate of 5% VAT. If you're importing any such goods from an overseas supplier and you are the importer on record, you are the one at the time of import who will be recording the output VAT as well as the input VAT of that transaction together at the same point of time. We will make it more clear with services as well, because as I told you, the import of goods and services both are subject to reverse charge mechanism. Let's take another example of services and then we will see how actually in practice the whole reverse charge mechanism works. Let's take an example of a law firm. Now you want some legal advice for your company. You have options, for example, to go to a UAE law firm and take services from them. Now, if you go to a UAE law firm and assuming that you're taking services for 10,000 dirhams of legal advice from a law firm in UAE, what will happen? When they provide you their service, they will issue you a tax invoice of 10,000 dirhams plus 5% VAT in UAE. So in total, you will pay them 10,500 dirhams. And the 500 dirhams VAT, which is reflected in the tax invoice issued by this UAE law firm, you will take an input tax credit of that in your VAT return because that's a normal expense in the course of your business. Now, in the same scenario, instead of going to a UAE law firm, you believe you will be getting a better or a proper advice on a certain legal matter from a UK based law firm. So instead of hiring a UAE based law firm, you go to a UK based law firm who is not registered for VAT in UAE because they're not making supplies on a regular basis in UAE. They don't have a fixed establishment in UAE. They don't have a place of establishment in UAE. And you go to that law firm in UK and take a legal advice, assuming the cost of providing the legal advice is the same, which a UAE law firm will charge. Now, what will happen in this case? The UK law firm, when they invoice you, they will invoice you of 10,000 dirhams only. They don't have any right to charge you UAE VAT. Although you are a recipient of services in UAE, but the UK law firm does not have any obligation to charge you the UAE VAT and they cannot charge you the UAE VAT because they are not registered for VAT in UAE in the first place. Now the VAT has to be accounted for someone. A transaction for supply of goods or services has taken place when you take these services from a UK law firm. So the VAT law shifts that responsibility to you. It is your responsibility. The supplier will issue you the invoice for 10,000 dirhams. But when you do the accounting entry in your own books of accounts, you will have to record 500 dirhams as input VAT and 500 dirhams as output VAT at the same point of time in the same entry in your books of accounts. It sounds illogical to a lot of people that how can you record output VAT and input VAT at the same point of time. The reason for that is the for the imports of goods or services, the VAT law makes the importer consider himself as supplier of those goods or services as well as the buyer of those goods or services. So as the supplier, you are accounting for the output VAT. At the same time, you're also acting as a buyer. So you are accounting for the input VAT as well. It's very simple entry. It's a very simple logical concept. And that's the basic rationale why you have to do it. We will understand a bit more on why of reverse charge mechanism first, and then we will go down to the accounting entries under reverse charge mechanism. A reverse charge mechanism is a mechanism to self-account for VAT. It provides clearly a cash flow benefits to the importer, but at the same time, it puts the importer and the local supplier at the same levels, because in net effect, whether you take a certain goods or service for the same price within UAE or you take it at the same price. I'm talking about the price in case of goods, it should be equivalent to a landed cost of those goods in UAE, which is the CIF price, which is cost, insurance, and freight. And services, it will be almost the same. So whether your landed price of goods or services from a local supplier in UAE or from an overseas supplier, if they are the same, the VAT puts both of them at the same level, and it distorts a competition or a competitive advantage to either a local supplier or an overseas supplier. Because when you pay the VAT to a local supplier, you have the ability to claim an input tax credit of that. So it never becomes a cost to you. Whereas when you're importing those goods or services, you are accounting for the output VAT and input VAT at the same point of time. So the output VAT and the input VAT gets offset against each other. So the net effect still remains the same in both the cases. In either case, if you're importing any goods or services for a business use and it is not relating to exempt supplies, the VAT will never become a cost to you, whether it is import of goods or whether it is import of services or whether you procure those goods or services locally within UAE. There are conditions to be fulfilled in case of import of goods, such as your import code and your tax registration number should be linked to each other. There's a process to be carried out for doing that. And we advise, if any of your businesses have still not done that, please make sure you link your import code and your TRN under the VAT law together, because then only you can get the benefit of get accounting for VAT under reverse charge mechanism. In case you have not done that, you will be required to pay the VAT in cash to custom authorities at the time of such imports, and which becomes slightly more difficult to recover. A lot of companies in the initial days of VAT in UAE, in January in particular, had faced these issues where they had not, or their consultants had not linked their import code and TRN properly, due to which they ended up paying the VAT to the custom authorities for clearing their goods. Subsequently, in their VAT return, they were able to take the credit for it. But if your entire business is only exporting the goods after importing it, you have to wait for a very long time to get the refund. And that position could have been easily avoided had you done the right process and applied the reverse charge mechanism for those imports itself. So the import or the benefit of reverse charge mechanism is not applicable, or you cannot avail it if you're importing any goods or services for purpose of making exempt supplies. For example, if you are into a business of owning residential real estate properties in UAE, and as we all know, that the rent of residential real estate properties in UAE is exempt from VAT. For example, you import into UAE lifts, which is for your residential building from Mitsubishi in Japan. I'm not talking about a new residential building, but an existing residential building, and you want to replace the lifts in your residential building which you own. Now, if you import these lifts from Japan into UAE and you're going to put that into a residential building, in that case, you do not get the benefit of reverse charge mechanism, which means you your output VAT will be auto-populated in your VAT return, which comes in box 6. As we all know, when you import goods and you clear through customs, the import data automatically gets pre-populated into the FPA portal, and which appears in your VAT return as a pre-populated number in the box 6 of your VAT return. And the output VAT liability is created for every single import of goods you make. Now, as long as you satisfy the conditions that those imports were made for the purpose of business, you are entitled to claim the input tax credit for it. If those imports are not made for the purpose of business, you cannot claim the input tax credit for it. Now, whether the goods which you're importing are fall in the or the services you're importing fall in the category of 5% or 0%, in both cases you will be able to claim input VAT as well as output VAT under the reverse charge mechanism. However, if you are importing anything which is for your personal use, although you import it under your company name, but it's not a business use, or it is an import relating to entertainment expenses which are disallowed under the VAT law, or it is an import for making exempt supplies, like in the example which I told you. In those cases, you cannot apply the reverse charge mechanism. You still have to pay the output VAT liability as appearing in the box 6 of your VAT return, but you can't offset it as an input VAT in box 10 in those cases. So there are exceptions where the reverse charge mechanism cannot practically be applied, but I would say those exceptions are hardly 5%. In 95% of the cases, you should be able to take the benefit of output VAT and input VAT in your VAT returns in box 6 and box 10 respectively. This is again a summary of what we have discussed in the previous slides, what you are seeing in the screen. The purpose of reverse charge mechanism, as explained to you, is to avoid distortion of competition between a local supplier and an overseas supplier. If the landed price to a customer in UAE is same from an overseas supplier and a local supplier, the VAT will not become a cost in either situation, although we agree that in case of imports, you have a cash flow benefit because you are not paying actual VAT. But even in case of local supply, there is actually you will be buying on credit terms from a local supplier. You are paying them the VAT only when you clear their payment. So there is not basically much of a cash outflow which you make upfront if you are buying on credit terms. But if you're buying locally within cash terms and you're buying from overseas on cash terms, you are better off importing goods or services because you get the cash flow benefit of not paying the VAT at time of such imports. As we said, the responsibility again shifts from the supplier to the buyer. It is applicable on both of imports of goods or services. It's a cost to a business which is making exempt supplies, or for all the businesses, it never becomes a cost. It is slightly complicated on terms of the counting entries, and which is what we are going to discuss and cover in our future slides. So one of the most important conditions for applying the reverse charge mechanism is that they are applicable for only and only registered businesses for VAT. So in case you're a business which is below the threshold limit, and for that reason you have not registered yourself for VAT, but you still make some imports effectively into UAE, either import of goods or services. If you're an unregistered business, those imports will subject to 5% VAT. For that very reason, if you have a business in which you're going to import certain things, we strongly urge that you don't need to wait for crossing the mandatory threshold limit of 375,000. Even when you cross your voluntary threshold limit, either on your imports or expenses or turnover, either of those three things, or the combined total of these exceed 187,500 and you qualify the criteria for the voluntary registration, please register yourself on a voluntary basis, because by doing that, once you're registered, then only you can claim the benefit of applying the reverse charge mechanism, which basically is a benefit that you don't have to pay any cash amount on VAT for the imports. So a common question which comes in is, okay, if I'm not paying any import VAT in case of imports, it means I have saved 5% VAT, whereas if I buy it locally, I have paid the 5% VAT. The answer is no, you have not saved any VAT at all, because whatsoever you pay to a local supplier, the 5% VAT, you have the eligibility to claim it as an input tax credit. So practically, there is no benefit which you get by buying locally vis-a-vis buying from an overseas supplier. And that is the whole purpose of introducing the reverse charge mechanism into the VAT system. This example will make this concept absolutely clear that there is no advantage in either of the cases. So if you look at your slide, you have three boxes in that slide. I will start with box number 3 from the bottom. We are covering an example where your company is making imports of goods or services from overseas, let's say from UK, which are related to your business activities. And the price you have agreed with your overseas supplier for those goods or services is 200 dirhams. Now, when you import those goods or import those services into UAE, as per the reverse charge mechanism under Article 48, you have an obligation to record the input VAT and output VAT both at a rate of 5%, which means you will record 10 dirhams of input VAT and 10 dirhams of output VAT. So this is the entry which you do at time of import. Now come down to the box number 2, which is above this. Now, the goods which you have imported, now when you sell these goods within UAE, for example, you determine the selling price of these goods as 300 dirhams, which means your profit on these goods is 100 dirhams. You import it for 200, you are selling it for 300. When you sell these goods for 300, you are obliged to charge 5% VAT to your customer within UAE. So with VAT, you will sell the goods for 315 dirhams, and the 15 dirhams will be recorded as your output VAT liability. Now, what happens as a net effect? Assuming that this is the only transaction which you are doing in the whole period, what happens is, if you this is your VAT return, if you file your VAT return, your output VAT in total will become 15 plus 10. The box number 2 plus box number 3 together will be 25. Your input VAT will be 10. Your net VAT which you pay to the government is 15, which is exactly the same amount which you have collected from your customers in UAE. So what happens in case of import and selling within UAE, if that is your business model? In net effect, whatsoever you collect from your customer on your selling price, that is what you pay to the government. 15 dirhams you pay to the government. Now, using the same example and comparing that with the local supplier. Now, if the local supplier from whom you buy the same goods is also supplying you the same goods for 200. Now, since he's supplying you locally within UAE, he will charge you 5% VAT on top of this. So in total, you'll be paying a 210 dirhams to the supplier, but his tax invoice, which he will issue you, it will show 200 dirhams as the VAT and 5% VAT on that, which will be 10 dirhams. So in total, you have an input credit which you gain on this tax invoice, which is issued by a supplier of 10 dirhams. You are selling this same goods to the same customer again at 300 because that's the price you have agreed with your customer. And you charge an output VAT to your customer, which is again coming in box number 2, which is why we have kept it in the middle at of 15 dirhams. Now, if your business model is of box 1 and 2, which means you're buying locally and you're selling within UAE. In this case, your VAT return will be combination of box 1 and 2, which means 15 dirhams is what you will charge as output VAT, 10 dirham will be your input VAT, net amount which you will be paying to the government is 5 dirhams. Now you have paid 10 dirhams to your supplier, you have paid 5 dirhams to the Federal Tax Authority. In total, even in this case, you paid 15 dirhams. So it just is a combination of how you pay the VAT, but whether you are importing the goods and selling it locally, which is a combination of box number 2 and 3 on this slide, or you're buying locally and selling locally, which is a combination of box number 1 and 2. The total VAT which goes to the Federal Tax Authority effectively is always going to be 15 dirhams, which is the price or the VAT which is collected from the end customer upon sales made to the end customer. The only exception to claiming the recovery of input VAT is in case of transshipment of goods, which will become applicable once we have a concept of implementing states. Right now, as we know, there is no concept of implementing state. Even Saudi Arabia is not considered an implementing state. But as and when other GCC countries start getting recognized as implementing states in the UAE effectively, from that point onwards, the VAT law has a provision that if you are transshipping the goods, you are importing the goods initially in UAE, but without clearing the goods into UAE, you are straight away shipping it, for example, to Saudi Arabia. Now, when Saudi Arabia becomes a GCC implementing state under the UAE VAT law, which currently it is not, but as and when it becomes, in this example, you will be required to pay the VAT at time of imports in UAE, but you cannot recover the input VAT of that. You can recover the input VAT for that by applying to the Saudi GAZ Gazette, which is the tax authority of Saudi Arabia, and you can recover the input VAT in form of refund in Saudi. It's a very complicated provision, but just was important to make you understand. Once we have the concept of GCC implementing states, this will be a practical issue which will come in claiming the benefits. Now, quickly running through the accounting entries for RCM, how do we account for the output accounting entries? So the first slide, which is there on your slide, is for a normal purchase which you make locally. The reason we have shown the entries is to show you the comparison on an apple-to-apple basis. If you make a normal purchase from a local supplier in UAE, your entry, for example, for 3,000 dirhams, your entry will be purchase account debit 3,000, input tax account debit 150, either on cash basis to cash account or to your creditor for 3,150. That is a normal entry which we all make for a local purchase. Similarly, on a local sale, my entry will be, if I'm selling something for the same price, for example, my entry will be cash account debit or my debtor account debit for 3,150 to my output tax account for 150 to my sales account for 3,000. That will be my entry for normal sales if I'm buying and selling the same goods at the same price. Now, the VAT law or the reverse charge mechanism is not too different from that. It is just a mechanism to self-account for VAT. It is a mechanism by which you are accounting for the purchase and the sale, but not the whole amount of purchase and sale. Only equivalent amount of output VAT and input VAT in the same journal entry. And most of the accounting softwares, including Zoho, they have the provision that you don't even have to pass a journal entry. They have a reverse charge mechanism which is auto-populated for you if you follow the right principles, and which the technical team from Zoho can explain to you. But as far as accounting entry is concerned, when you import goods under Article 48, and you are or importing services under 48, Article 48, and you're applying a reverse charge mechanism, the entry which you see on your screen is what you record, which means purchase account debit 3,000, input tax account debit 150, to output tax account 150, to bank and or the payable account for 3,000. So this is a basic entry which you have to make, whether you're importing goods or you're importing services. In both the cases, this is an accounting entry which you need to pass. The subsequent slides, which you will be able to see on the presentation, I will not go through them because these are just the explanation of this basic accounting entry on how do we derive up to this accounting entry. But this is all you need to do. It's as simple as that. The journal entry which you are seeing on your screens, this is all the reverse charge mechanism entry is all about. And the accounting softwares like Zoho Books have a system which allow you to record reverse charge mechanism entries in a very simplified manner. So please make sure that every single import of goods or services you make, you have properly accounted for the reverse charge mechanism. Although there is no cash payment, but if you have not done these accounting entries in your books, you are non-compliant with the VAT law, which exposes you to the fines and penalties.